You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
There we go. So today's session is our RIA Roundtable. And before we get into the meat of the agenda, could we get a quick survey on who in the audience, show of hands, is an RIA or with a family office? Great. Pretty good percentage of the population. So joining me on our panel today are Zoe Brunson, who is with AssetMark and really runs the investment platform at AssetMark. Bill Harding with Jackson National Life Insurance Company, Jackson National Asset Management, and I must give a tip of the hat to Jackson, who did just a great job in hedging their assets on their balance sheet during the last financial crisis in 2008, 2009, and Paul Courtney with SpringTide Partners. Serving as a research and due diligence organization, providing help with asset allocation strategies for RIAs and family offices. So what we'd like to do today is, I thought I'd kick things off and try to set the stage in terms of identifying some of the trends that are going on in the broadly defined wealth management industry. That is the industry that RIAs, family offices participate in, and then we'll also provide this overview, if you will, really as context for them to have some questions and answers from our panelists about these trends and how those trends are impacting their businesses. And then we'll open it up to all of you for some more questions and answers. So what we've done is we've identified several key trends that are going on in the industry. And probably trend number one is the fact that we've experienced and are continuing to experience massive flows of assets into passive index funds and ETFs. These long-only strategies, quite simply, may not fare well during the next bear market. And I think it's incumbent on all of us to think about, what does this mean to investors and advisors who have 100% long-only passive portfolios that they're using to plan for their ultimate retirement and financial security. Secondly, second big trend is fee compression, right? We're seeing fees coming down, being compressed across the board. And it's true for asset managers, it's true for advisors. It's true for platform providers as well. Third big trend, and I'm trying to see this a little bit closer, is that, and this is no surprise to anybody in the room, but the regulatory environment continues to increase. It continues to tighten. And firms across the board are experiencing increased compliance costs. So what ends up happening is profit margins get squeezed across the board, right? As a result, many RIAs are starting to make much better use out of technology to help them scale their business. The next trend is the advent of robo-advisors, right? We've all read about them in the newspaper, in the industry press. We've seen the Betterment commercials on TV, probably more times than we care to remember. But we've seen this whole advent of digital advice tools, robo-advisors, that are coming on the scene. And for advisors, I think they need to make an assessment as to whether these digital technologies are a legitimate threat to their livelihood, to their businesses, or are they a tool that they might be able to use in their businesses to help them serve other segments of the market. Next trend is just the pace of mergers and acquisitions that's going on in the industry. I think every week you read in investment news, the Wall Street Journal, that there's a very brisk pace of merger and acquisition activity, whether it's technology companies, advisor teams acquiring other advisors, you name it, but it's significantly changing the landscape. And now firms that remain independent really no longer know with confidence with whom they cooperate and with whom they compete, right? Who do we partner with and who do we compete against? So it creates this environment of coopetition, as Bill Gates liked to coin the term. So in order to size the market, there's 311,000 advisors in America, right? 311,000 wealth managers. I mean, everybody is a wealth manager. And that doesn't matter if the advisor is associated with a broker-dealer, with a private bank, with a bank trust, if they're an independent RIA, if they're associated with an insurance company, an accounting firm. Everyone is a wealth manager. And thus, it creates some confusion in the eye and the mind of the consumer, right? That is, how do I, as a consumer, as an investor, differentiate between all these different types of advisors and their service models? And we'll talk about how these firms help their advisors differentiate themselves in the marketplace. From a market share perspective, the fee-based, fee-only RIAs are grabbing market share from the broker-dealers, right? I mean, the business model of commission-based service from broker-dealers is quickly being replaced by fee-based advice from advisors. And the final trend here is that now the SEC has come out with some new advice rules, technically proposals, at this point in time. They're coming right on the heels of the DOL fiduciary rule, further confusing the investor and the investor marketplace. Who's a fiduciary? Who's an advisor? Who's a broker? What does it mean to me, the investor? So really the key question on all of this is, how do RIAs differentiate their practices and add value to their clients? The investment dilemma is, how do I structure my clients' portfolios to ensure successful retirement outcomes and help them go through retirement, and after we've accumulated this asset to fund your retirement, How do we convert that to a successful retirement income strategy that's going to support my client for the rest of their lifetimes? The business issue that we need to address and really focus on is how will my practice survive a fat tail event? If my clients' portfolios are in long-only strategies, and we won't get into the active-passive debate like we did at the last session, but how will my practice, my advisory practice, survive a fat tail event, right? And we've been talking about all the risk factors that are out there at today's conference. And then if I'm seeking to try to hedge the performance of my clients' long-only portfolios by introducing alternatives into the portfolio, shouldn't I remember what happened in the 2008-2009 financial crisis when correlations for these alternative investments all went to 1 and everything fell out of bed at the same time? And then finally, what do advisors do? Do they maintain or pursue some type of ostrich strategy, stick their heads in the ground? You know, I'm just going to ignore all of these risk factors that are confronting my clients, their portfolios, my business, right? Or shall I think about this a little bit differently? Shall I think about preparing, justifying, restructuring portfolios today for some of the significant damage that may happen tomorrow? So with that, why don't we start by let's start with Zoe. If you could just tell us a little bit about your business, tell us a little bit about AssetMark. What are your roles and responsibilities?
Sure.
What all you do? Numbers of advisors, assets under management, all that kind of good stuff.
Sure, happy to. So AssetMark is a turnkey asset management platform really targeted to the independent broker-dealer network, but also to some RIAs as well. So we have about north of 8,000 advisors that use our platform to really outsource a lot of their capabilities, whether it be from the investment side, from the back office side, to really allow themselves to focus on the client relationships, which is really where they want to spend most of their time. So the role that I have at AssetMark is really around the investments that are available on the platform. We only provide asset allocated solutions from a wide variety of investment managers. And we, as kind of the emphasis of this conference has been, is about going beyond kind of what I'll call asset class diversification and into strategy diversification. Really thinking about how to use complementary different strategies on a consistent basis, not a tactical basis, but to be diversified across traditional core market, MPT type strategies, combining them with tactical strategies that can enhance your return or can limit your losses, and diversifying strategies that can help manage in those times of stress, whether it be equity alternative type strategies like managed futures that did prove to be successful in the times of severe downturns, or whether it be looking at other alternatives to bonds, given where we're going in the bond environment today. So it's really about being diversified across those different solutions. And what we have actually found is from our advisors that those that really adopt that mentality of having a mix of strategies maintain their clients for longer, providing more consistent experience for their clients because they're not digging themselves into a hole. They don't have to take as much risk to recover. They can actually, over the long term, hold more equity in their portfolio by using these other diversifiers to risk and managing risk more efficiently in their total portfolio.
Right. Paul, do you want to?
Yeah. So SpringTide is an outsourced research and investment consulting firm. We serve about 15 clients in the RIA and wealth management space, family offices as well. My background was previously at a relatively large RIA here in town. Our offices are a couple of blocks away. And we started a little over a year ago. We advise on about $2.3 billion in assets. And I would say the philosophy of the firm, which obviously drives a lot of what we do, is probably somewhere between the comments you heard from Rob and Randy and Meb. We believe very firmly in mean reversion, but we also believe in trends. We believe in active, but we also believe in passive. We believe in public markets, but we also believe in private markets. And so I think what we're trying to do is present an offering that's a little bit more of a common sense solution to, in my opinion, a space that's sort of been pinballed between the hot dot on the asset management side for many years. And I think understaffed RIAs and to a lesser extent family offices are sometimes on the wrong end of that. Anyway, so open architecture, the majority of the underlying assets are taxable. I'm not sure if I said that. And we help our clients with a variety of topics. Someone brought up the fact that, I think it was Meb in his first session, how important it is to have a global investment policy statement. And so that's often the first part of an engagement. And then soup to nuts, sort of deep dives into portfolios. This is where exposures are. This is where we think they should be. And ultimately landing up on model portfolios that try solve for what the client ultimately needs to do, but we obviously have opinions on things.
And then just to be clear, you don't provide any middle office or back office services?
Purely investment.
Custodian neutral,
no, custodian
kind of like
neutral.
Switzerland?
Yes.
All that? Yep. Yeah. Okay, good. Bill?
Yeah, so I'm with Jackson National Asset Management. We're a leading provider of variable annuity funds with $220 billion in assets under management. And we have a wide variety of investment solutions, 160 different variable annuity funds on our platform. It's a kind of best-of-breed model. My team is responsible for selecting the external money managers we work with. We work with about 50 to 60 external managers. We have a range of solutions from active to passive and have most of the asset classes and different investment strategies represented, including traditional and alternatives, on our platform. So it's a very robust platform. We give our advisors and their clients investment freedom, meaning they're free to choose from the different variable annuity sub-account options on our platform, which is maybe a little bit different and unique from some of the other big VA providers that have maybe forced clients into managed vol products or different or more limited menu of investment options. And I think because of that, our clients have had a probably much better outcome over the last 5-6 years. And I think what's interesting in light of our discussion in this panel on the RIA market is that Jackson is right now in the midst of a significant transition. And traditionally, much of the VA business and our business was really on the commission side, working with broker-dealers, and that's still a big part of our business. That's where we're the leaders. But we've recently launched some new variable annuity products that's more targeted to the fee-based financial advisors, so different fee structures, utilizing institutional share class funds. Again, so much a little bit different model because we see where the market's going, and maybe it's accelerated that move with the DOL and all the different regulatory things that have come up as well. So I think that's kind of looking forward where we see a big opportunity for the overall pie for the VA business to grow with that shift to fee-based.
Mm-hmm. Great. So just in the interest of full disclosure, my former employer, Investnet, that acquired my company, Prima Capital, competes directly with AssetMark as another turnkey asset management platform. I'd say indirect competition with Bill, and probably indirect competition with Paul, right? Just so you understand the kind of the subtleties and the differences in the business models. So of all those investment products and strategies that we just rattled off, what are the most popular with the advisors that are using your platforms?
So,
and why?
I would say where we've seen a lot of growth over these past few years would be no surprise, because what does investments follow? It follows performance. So we've seen a lot of asset growth into what I would call traditional core type strategies. that take that kind of globally based approach. But where those assets have been placed in those strategies, because we have a range. We have active, we have passive, we have a range of fully global versus more domestically focused. Where I would say we've seen most interest is really on our lower cost, broadly diversified, representing global capital markets type strategies and solutions, and less so on what I will call the actively managed higher conviction. That's what I will say for the mass affluent. What we've also seen is a huge influx of assets into our higher net worth space where there's more customization of services and capabilities, where they don't want just traditional global capital markets. They do want, whether it be tax transition, whether it be bringing in large holdings, that wider glove service to go along with it. So it's kind of been a bifurcation in terms of lower cost solutions, but then also the tactical side. What I'll add is, as we came into this year, not just when February happened, but as we started coming into this year, we started to hear from our advisors about, we've got concerns. We've been 9 years into this bull market, what to do? And so we've seen a greater interest in some more of the tactical-based strategies, or how do I think about that rising rate environment and putting something into my portfolio that's not so stressed or sensitive to traditional rates. So it's been kind of, there have been the two extremes, but we've started to see as we came into 2018, that gradual shift of, hey, this can't go on for too much longer. We've got to find some different ways to help manage our clients' portfolios so that they're not going to feel that downdraft.
Mm-hmm. And so not to get too technical here then, Zoe, but the products or the vehicles that you're providing include mutual funds, ETFs, traditional separately managed accounts.
Not quite.
And model-based?
So all of our solutions are model-based. We're curated, and we're all model-based. We don't actually offer the individual SMAs. So if you come to us, you would get a fully diversified portfolio following a specific asset allocation approach. So traditional core markets, modern portfolio theory. And that would be a mix of either mutual funds or ETFs. And you could complement that with another solution that is more tactical, that will move in and out of the markets. And you can accompany that and complement it with a managed futures type position as well. So it's really about having different types of models that you can combine together to create that all-around portfolio to meet a specific client objective.
Pretty much regardless of account size.
Mm-hmm.
Yep, great. Paul, do you want to take a stab at that same question?
And I'll maybe split my response into RIAs and then family offices, because I do think they're trying to solve for maybe different time horizons and risk tolerances, and so they're landing up in different places. RIAs, I think, and I mean everyone can sort of guess, they're struggling with the same stuff I think everyone is. Underlying clients are asking the question why active hasn't performed relative to just a traditional 60-40, or at least the 60 portion of a 60-40 for many years. And there's a lot of pressure on fees. I think they all caught the sort of min-vol or the factor bug. Unfortunately, a lot of them caught it at the wrong time, and they sort of chased the factors that had done really well. So DFA had a massive influx of assets when small in value had done well. AQR across their different silos had a massive influx of asset when various AQR factors had done well. And so they want to differentiate their businesses, because you can't really differentiate anymore if you're just doing iShares or DFA or AQR. But then at the same time, they also are very careful and I don't think want to stick their neck out with active management, because they're used to this world of allocating to active managers when they've been doing well, which is then typically when they sort of mean revert. So we like stuff that is very different to what they have come to us with, and what we're trying to do is really go polar opposite to that. And we've started to, the last couple of months have helped, but we've started to notice some traction. We started moving into energy partnerships, midstream assets end of last year. Knock on wood, we got lucky with trimming some risk in late January, and that was concerns about where we were in the cycle, and massive Fed issuance happening in February. So sort of post-debt ceiling stuff, and then long, short, and anything that's active value we think is is priced incredibly cheaply. If you look at factor versus some momentum factors versus large cap or value across growth factors, value versus growth, they look really, really attractive. And then on the family office side, sorry, this is a sort of a long response, but on the family office side, I think they're all sitting on a lot of cash. They've been divesting real estate portfolios for a number of years now. Hard asset lending has been popular, but I think there's just a lot of concerns. If deploying any capital into a private market now, you're probably going to have to hold it through a recession. That's not a forecast. I mean, especially if based on, I think it was Sam's comment earlier about the terms for these funds getting extended past 10 years. We're probably going to have a recession within the next 10 years. I think they're of the mindset that you probably just get better pricing if you just sit on your hands for a little while.
And then same follow-on question with regard to investment vehicles, and particularly on the alternative side. Here you're looking at limited partnerships.
So we can do anything.
Liquid
we'll
alts.
work with the advisor. Sometimes we're given sort of more strict constraints. They may be amenable to K1s, but as long as they're timely, which is obviously the partnership space. Sometimes it's ETF only and a solution for small accounts. But I mean, we can work because we're not sort of tied to a custodian or we're not running a platform ourselves. We can work with them and build something that suits whatever constraints they give us.
Like Switzerland, right?
Again.
Yep.
I'm going to use it.
Yeah, good. Bill, same question for you.
So we've seen some
most popular.
some general trends of the advisors being more aware of the kind of low cost investment solutions we have on our platform. So we've launched a number of strategies with Vanguard back last September that have been pretty popular, in addition to some other index funds that we have on the platform. Now looking back, last 6-7 years, obviously it's been hard to beat the indexes, especially U.S. large caps. I think some of that's been just kind of performance chasing, and we're starting to see, I think, more flows going back into some of our higher conviction active managers. We across the board, some balanced type funds that are very popular with our advisors, like a T. Rowe Price Capital Appreciation, kind of one-stop shopping, if you will, high conviction type of manager. More recently, this year, I think we're starting to see, as international markets have come back into favor somewhat, starting to see some movement back into some international equity, global type strategies where, again, a few years ago, I think everything was more U.S. focused. So it's good to see some of that diversification coming back into play. On the fixed income side, obviously, it looks like our advisors are prepping for a rising interest rate environment. So seeing some flows into strategies that are maybe do better in a rising rate environment, such as floating rate bonds or unconstrained bonds, strategic income type strategies that, again, maybe won't be as just sensitive to a rising interest rate environment. Great.
So the next question is really intended more for Zoe and Bill. What sort of digital tools or robo-advisor tools are you introducing to your platform?
Sure. So we have a variety of tools because we are curated. We don't try to be the huge supermarket, hypermarket. We try to really think about having unique, differentiated strategies and solutions on our platform and being able to set the right expectations for our advisors to use with their clients. So we have a few tools available today on our platform. One of the key tools that most advisors use on our platform is something that's we proprietary built called Portfolio Engine, and it allows you to put these different solutions and strategies together to look at the different types of risk, because risk isn't one-dimensional, as we've all heard today. It's multidimensional. So how do you think about looking at it? Drawdowns, volatilities, scenario analysis. And so that tool is available for our advisors to put portfolios together, to use different solutions within it, and to see that impact. And they can see the impact of that one solution as individual solutions or together as a portfolio to see how they work in together or not. And what's been quite interesting is advisors that have really become power users of that technology have started to use it with their clients. And they've started to talk about strategies and solutions that in the client's eyes may not be performing so well. And we have one instance where an advisor used it with about a combination of solutions and strategies. One particular strategy had been kind of the dog of the portfolio. It had been really, really bad. But after the conversation and showing the use of this tool and how what's the purpose and why we're holding different solutions and strategies in your client portfolio, this client actually turned around and said, "Is now the time that I should be adding to that dog?" So just the powerful use of putting things into simple pictures and talking about why you're holding a certain type of strategy, what's its purpose in the portfolio, and how it's being used in different scenarios and different market environments is pretty powerful when you're talking to your end clients. And so we do have that tool that can be used at the front end, can be used at the back end. So that's really kind of the most powerful tool. There's a lot of other stuff that we're doing in terms of the digital interface. And I know this is going to get into part of the dialogue, is that I don't think robo-advisors are really going to hurt the traditional advisory business. People still want interaction. They still want to have that personal connection with their advisor. What is going to change is the way that you talk and the way that you interact with your clients. And the fact that the improvement that you're going to see from the technology side in terms of how you present, the user interface, how we express our ideas and getting content out there is going to change. So it's going to make us all focused on building better technology and having that scope and presenting things in a way that people can easily understand and not just look at performance anymore. It's going to go beyond performance, I think, as we go forward.
Great. Bill, digital advice tools?
Yeah, we do less
goals-based financial planning, et cetera?
Yeah, we don't really offer a lot of specific tools on our site, or in that way, we have more of a service model where we work, hand in hand with the advisors. We have hundreds of external wholesalers and internal sales folks and portfolio strategy group, and they're the ones really kind of working hand in hand with the advisors to try to get to a solution. So we utilize some different resources to help in that, and we have a portfolio construction tool that's kind of powered by Morningstar, where again we were kind of, our wholesalers portfolio strategy group would be working with advisors on a specific case, or let's look through maybe a portfolio they already have for their client, go through like the holding space analysis lens, see where they might have gaps or why maybe the portfolio is not very diversified, and you can run also some risk-based analysis on that, or look at some simulations of how that portfolio might perform, and then offer recommendations. And often it's very basic. Well, maybe they're all it's that home country bias that Meb highlighted earlier, but again, it's filling in the gaps from a holdings-based asset allocation perspective, letting them know then which variable annuity funds that we have on our platform could help round out their portfolios and offer them maybe a little bit different experience and solutions.
Now, what about any tax transition tools or tax efficiency tools?
I think we just kind of try to highlight with the variable annuity. Obviously, one of the benefits is the tax deferral nature. So that's more of an education of, why the variable annuity, what's that, kind of bring to the table in terms of tax advantage. So yeah, in certain cases, we might illustrate how some types of investments are, much better within the VA wrapper because of the tax deferral nature. So especially within some of the alternative strategies, again, they could be very, higher tax implications, so you want to hold them in a tax deferred vehicle like a VA. So we would provide some illustrations to that as well.
Great. So shifting gears a little bit, Paul, let's talk a little bit about, I know, one of your favorite topics. The industry, that is the wealth management industry, has rightfully been criticized for advisors chasing the hot dot, that is chasing that top performing manager over last quarter, last year, last 3 years, last 5 years, all based upon historical performance. What are you doing to kind of advise your clients not to chase the hot dot, but to rather do what's in the best interests of their clients? Any changes in reporting systems that you're using to take a different approach to presenting client reports, performance measurement reports?
Yeah, we do think it's a pretty big deal, and I think it's because we've lived it. I mean, our entire process now, and that's all we have is a process, is the result of making every single mistake you can possibly make for however many years, 12 years we've been doing this. We literally have made every single mistake you can possibly make, and the ones that I think in hindsight hurt the most, and we've made some colossal mistakes in this regard, fortunately not the last couple of years, we've made other mistakes, but is getting out of managers after whatever, couple of years of rough performance right before they then go on to a winning streak. And so we spent a lot of time researching it. It's amazing how much really good research there is on mean reversion of excess returns of active managers, or factors if you want to go passive as well, or asset classes if you want to sort of zoom out, currencies. I mean, we believe it so much we sort of named the firm after it. I mean, SpringTide it's the largest gap between low tide and high tide. And so we spent a lot of time educating clients on it from, I mean, really basic stuff. Like Morningstar has white papers talking about how 5-star funds underperform 1-star funds. I think having the conversation through the lens of a practitioner as well, and having sat across the table from a client that says, I get it, I don't care, I'm out. And that's the reality of it as well. And so I think it needs to be sort of a holistic solution. I think it needs to be proactive in that when you have a strategy that's done really well and you cannot get out of it because of a low cost basis, you have to have a conversation with the client about, hey, this manager is not a 4% over the benchmark a year manager. We think there may be a 1%. And so what does that look like? Like the next 3 years could be rough with this active manager. We're not going to change our plan. Let's write it down. Let's revisit this in 3 years' time. Benchmarking as well, sort of like, I would say on the benchmarking side, we try keep things, we benchmark to investable benchmarks first of all, which makes it easier for active managers, which I think is apples to apples. We'll use a low-cost ETF or whatever the lowest cost fund is. And then we try keep the benchmarking as holistic as possible, because you don't need to drill down to the most granular level all the time. If you were managing a long-only strategy, you may be adding to a stock that was down, or you may be adding to a position, whatever the strategy is, that was down. Don't report performance in a way that prevents you from being able to do that with a manager that you still like, but happens to be really badly out of favor. So it's hard. I think it's the most challenging thing in this business. And the studies that talk about the sort of tax of rotating out of poorly performing managers and constantly buying the hot dot suggest, depending on the asset class, that there's hundreds of basis points of excess returns just sitting on the table there. Mm-hmm. And it's challenging to get right. Obviously, you can't just buy underperforming managers and sort of hope for the best. They do have a tendency to go out of business a little bit more frequently. But if you can find a strategy that, and like landing the spaceship for today's conversation, and this is unbiased, we don't currently have capital with Swan, but a strategy that's done well since 1997 and happens to be out of favor, like to me, it's a no-brainer.
Mm-hmm. And just to add to that, I think the education side is critical. We've tried to do that in terms of improving the content and material that we're constantly putting out. Yeah. Like in the 11 years I've been at AssetMark, I can't tell you how many times we've changed our collateral and our material to try and make things simpler. And we're continuing to do it to the point that we're putting out smaller, briefer points in terms of why we like the solution, how it's going to add to your portfolio, and what to expect. No more than 10 bullet points is what we're doing this in. So it's all about, in today's technology, people want things quicker, shorter, snappier. I don't want to read a 3-page document. I want to hear it in the keynotes version. And I would say the other side is the pictorial side. Pictures paint 1,000 words. And to your point about buying last year's losing strategy and holding it for the next 12 months, we've done that. It's an easy old, if you like, the old Callan charts, as I used to call them. You look at last year's worst performing asset class, hold it for 12 months. Hold last year's winning asset class, hold it for 12 months, and do that over the 20-year cycle. Guess what portfolio performs best? Last year's losing asset class. Now switch that, and we actually have done it on our strategies on our platform. What was the worst performing strategy on the platform? Hold it for 12 months. Guess what? That's a portfolio that does the best than rather holding last year's winning strategy. So it's really trying to express that and also expressing that you don't want to be switching and chopping and changing from one asset class to another or one strategy to another. You really need to hold them consistently. And again, we don't hold the Swan strategy right now. We're doing due diligence on it right now because that's the cornerstone of our platform and understanding it. But it's very similar. You want to have 3 different types of solutions or strategies all doing different pieces of your portfolio and hold them consistently. Don't jump in and out at the wrong time because you're going to time it badly. And we've made those mistakes too, and we've learned from them.
Great. So shifting gears again, let's talk a little bit about how you see the SEC advice proposal, although it's in its very young stages of development and comment period and everything else. But how do you see this SEC advice proposal impacting your advisors, impacting your businesses, and what sort of help are you providing to advisors to navigate through that?
Well, I think Jackson, we're advocate of the SEC kind of taking a look and coming up with a comprehensive view. We thought with the DOL, it was very confusing. You'd have kind of different standards for the same advisor if they were working with a client on their qualified money versus non-qualified. So to us, that didn't really make a lot of sense. So in our mind, we're looking forward to a comprehensive, policy that makes sense. And I think Jackson's probably been a little bit more active in Washington, D.C. to try to, talk about variable annuities and the role. And it's a very big education process. And a lot of people there in Washington just didn't really even understand that there's a guarantee associated with these variable annuities, and that's kind of the whole benefit to them. So it was an education process, but we think at the end of the day, whatever rule comes out, if individuals go to their financial advisor and say, hey, I need to solve for this retirement income problem I'm having, the advisor may, it may be in the client's best interest to talk about a guaranteed income product, which is a variable annuity. And then in kind of looking at the different providers out there, Jackson with our investment freedom and our lineup, should be a solution that's probably worth, talking about for the advisor. So I think when it all comes out at the end, we feel in a pretty good position, but it's absolutely caused a lot of disruption as advisors have been making a transition, and a lot of broker-dealers have already kind of changed their models a little bit, getting away from the commission-based products to fee-based. So it's led to a little bit of I'd say a blip, and for the industry overall, and a little slowdown in sales. But I think looking forward, we just see a much bigger potential pie there and ability to grow that in the future. So.
Great.
So I'd say from AssetMark's standpoint, we've been fee-based ever since our foundation back in '96. So that was kind of our grounding. And so this change is just, we're seeing more advisors come to us because they like to have that outsourced capability. They like the fact that we have a team of 5 dedicated to due diligence. All they do day in, day out is care about who's on the platform so that they don't have to worry about selecting and picking the best solutions and strategies, as well as how to combine them and outsource. So I would say for us, we've seen a greater number of advisors coming to the platform because of that ability of being able to say, I've got someone else looking over my shoulder for me and offering those additional services that they don't want to have to do themselves.
Yeah, great. And Paul, I imagine it's pretty positive for your business.
We actually have a couple of prospects who basically told us that until the fear of litigation motivates them to move ahead, they'll be sitting on their hands. So we're biased.
It's either fear or greed, right? So, yeah, great. So, final question. Given that you're the senior executives, the stewards of all of this capital on your platforms, and you're the trusted advisor to the advisor, what keeps you up at night? What do you want to prevent in a worst case scenario, and how are you going about preventing it?
I would love to prevent the performance chasing mentality of the advisors, which we kind of already talked about, and I think it's just kind of human nature. Unfortunately, especially we offer this investment freedom, and we let the advisors and their clients pick the different sub-accounts and trade, whenever they want. And you see sometimes in the flows, I can see them, unfortunately, chasing performance. I think what we can do is just to make sure that, we have money managers that have been consistent, that, we don't tend to pick managers that, have had the one great year type of thing. We look for managers that are, deliver good risk-adjusted performance in consistent fashion, and we pay more attention to some of the qualitative aspects of the organization and the people. So I guess we try to keep some of that away and off the platform to begin with. So I guess our biggest, concern is just even, with the different strategies we have, just our advisors kind of mistiming things and not having as good of an outcome as we can. But overall, again, we're pretty confident with the managers that we have on our platform, and at least, relative to their indexes and peer groups, hopefully they'll get a pretty good outcome.
I would say probably is misunderstood expectations. One solution or strategy, depending on how it's represented, can be thought about in many different ways, and making sure that the expectations on how a strategy will perform, how it will behave, and what's the worst case scenario you can expect from this. So part of all of the dialogue we have as part of our due diligence is understanding what are the critical elements that go into investment decisions, really getting into the depth, the nuts and bolts of it, and then what does that mean for expectations around how the portfolio will be built, how it will perform, what environments does it do well in, what environments does it not do well in. So if we go talk to an investment manager and we say to them, what's your Achilles heel? And they turn around to us and say, we don't have one. Guess what? We're running for the door.
We got a red flag.
Because every solution and strategy has an Achilles heel, and you've got to know what it is and when it's going to occur. Because when you come to it and put those solutions and strategies together, it's like putting asset classes together. You don't want them all to correlate to one in the times when you most need diversification to work. And so again, I'll go back to one of the advisors on our platform who's been with us since our foundation in '96, if not before. And he said at one of our big premier events, I'm putting solutions and strategies together. If I'm not apologizing for one strategy every quarter, I'm not fully diversified. So there should always be something that's probably not working as well as you want it to be, because you know what? Now's not the time for that strategy to be working. So really understanding and having the right expectations of what strategies are going to do, how they're going to perform, when they're going to do really well, when they're going to do really badly, and how they're constructed is really going to help you to build a complete solution that's going to manage risk efficiently for your clients so that they can meet their long-term goals. And that's what's critical, I think, in terms of setting those right expectations for the long term. It's going to help you have easier conversations with the clients as you talk about, are they meeting their goals or not?
Well said.
Yeah, I mean, I would echo both of that. I think Zoe crushed it. I would definitely, echo all of that. I think John gave us some stuff to be concerned about, a lot of things to be concerned about.
Some stuff to be concerned about.
Well, I'll be losing some sleep over. But I think there is a lot. We're obviously 9 years into an experiment where, just in the US, $4 trillion of fungible currency was used to displace, or rather, people did not need to come up with that amount of money to purchase bonds and equities and a whole host of things, and rates were kept low for a long period of time, and I think that has pushed people out onto the curve. And yes, there's absolutely a lot of good news. We're worried that is all but baked in, and maybe and then some. I think people are quick to sort of point out how strong earnings are. We went through 5 quarters in a row of sequential quarter-over-quarter earnings decline, post-15 into early 2016. And yes, the median stock sort of had its own little bear market, but the S&P 500 didn't really skip a beat. I would summarize all of that stuff going on as we think the Fed pulled duration risk out of the market. Mm-hmm. And you really want to scare yourself, go back and read, they released them earlier this year, go back and read the October 22nd, 23rd, 2012 FOMC meetings. And Jay Powell's in the room, and he basically has this great quote where he talks about how they're talking about quantitative easing, and he's like, so it sounds like we're going to, and this isn't verbatim, I'm going to screw this up, but it sounds like we are blowing a massive fixed income credit bubble across the credit curve. And he also talks about the suppression of volatility. Like, they knew what they were doing. We have to find a buyer for $10 trillion worth of fixed income supply over the next 5 years. $1 trillion plus in treasuries, and then there's obviously high grade and junk supply. It's just a lot of money. I don't know who buys it. So I think we're sort of looking at a lot of people throwing money into 60-40 portfolios, another stupid little thought experiment. So the Barcav Ag has the highest duration and arguably one of the lowest yields it's had in a very long time. The duration is about 7.5 times. And stocks, if you just want to do sort of a rough proxy, 1 over the dividend yield, you may be, and it's not a great calculation, but the duration of about 50. So combine the two in a 60-40, and you're looking at like 30 duration on just a traditional 60-40 portfolio. So again, echoing what Zoe had said, I think it's time to diversify out of traditional 60-40, long only 60-40.
Great.
Sorry, that was long.
Great. Well, we're almost up on our time limitation here, but I think we have maybe a couple of minutes for a few questions for our panelists.
A question for Bill.
Yes.
If you go back to maybe 2007, 2008, probably the top 6 or 7 VA providers are out of that business now. Benefits have changed, obviously. They've repriced. They've been brought in a little bit. But even since that, Jackson's had a couple of years where they had to restrict purchases at the end of the year. What do you see happening when the next crash comes? The shakeout at Jackson, if there would be one, and the rest of the industry?
Yeah, so I think, I guess one of the benefits of why Jackson came out of the downturn in better shape than some of the other providers was, we were more rational in that time period, 07, and we weren't in the top 5 or probably even the top 10 in sales in the VA because we weren't willing to play that pricing game and offer benefits that were too rich. And we also always used the capital to hedge the book, and most years we lose a lot of money on the hedges. Like last year, I mean, it was probably a record year in terms of the amount the hedging group lost in terms of derivatives, but it's supposed to lose in an up year. So, we're all about managing risks, and I think that, we're not concerned about a downturn from that perspective because we know that we're hedging the risks in the book. So again, next type of downturn, we expect to kind of come out strong as well because we know the book is hedged. We've taken risk pretty seriously and written things appropriately, and our book is profitable and everything like that. So that doesn't concern us as much. So.
Could create some acquisition opportunities for Jackson, right?
Yeah, they probably had a couple that they passed on in looking back that they probably wish they could have, but part of the limiting the flows or sales at year end, ultimately had also been a result of being owned by UK insurance, UK parent and Prudential PLC, and the regulators had some requirements and things like that. So they probably would have done a little bit more acquisitions if they could have. But.
Yep, great. Okay, anything else? All right, great. Thank you, everyone.
Thank you.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.